Hi everyone, I'm Khalstian, founder of Egg Capital, and welcome back to the channel. Today we're diving into a hot topic: President Trump's new import tariffs, which have reignited trade tensions. By imposing hefty duties on imports from Canada, Mexico and China, the stock market has reacted sharply. But what does this mean for long-term investors? Should you be concerned, or is this short-term noise? To help you navigate this complex issue, we are going to break it down into 4 key segments. First, we'll explore what tariffs are. Next, we'll look at when tariffs have been beneficial. Then we'll discuss when tariffs backfire. And finally, I'll share how investors can prepare for import tariffs. Let's get started. Now, before we dive into history, let's quickly define tariffs. A tariff is basically a tax on imported goods. If the United States puts a 25% tariff on Chinese steel, that means any company importing steel from China has to pay an extra 25% on top of the normal price. The idea is that this makes foreign goods more expensive, pushing consumers and businesses to buy domestically instead. Sounds simple, right? Well, the impact on businesses, consumers and investors is far more complex. One of the biggest arguments for tariffs is that they protect young industries from foreign competition. In the 19th century, the United States wasn't the industrial powerhouse we know today. Britain had a well-established manufacturing sector, and American factories struggled to compete. So early US leaders like Alexander Hamilton pushed for high tariffs on British goods. The Morrill Tariff of 1861 helped protect American manufacturing, allowing industries to develop without being crushed by cheaper foreign products. Germany did something similar in the late 1800s. Economist Friedrich List argued that free trade was great, but only after an industry had grown strong enough to compete. So Germany imposed tariffs to develop its industries, eventually becoming an economic powerhouse. These cases show that in certain situations, tariffs can actually boost long-term economic growth. Now fast forward to the 20th century. Japan and South Korea followed a similar strategy. After the Second World War, Japan imposed tariffs and trade barriers to protect companies like Toyota and Sony, allowing them to grow into global brands. South Korea did the same with Hyundai and Samsung. These countries eventually opened up to free trade, but only after their industries became globally competitive. The key lesson here? Tariffs can work if they're temporary and targeted at growing industries. But tariffs aren't always a good idea. A perfect example is the Smoot-Hawley Tariff Act of 1930. During the Great Depression, the US thought raising tariffs would protect American jobs. Instead, it triggered a global trade war. Other countries retaliated with their own tariffs, making US exports more expensive overseas. The result? Less trade, more economic pain, and millions of jobs lost. This is one of the biggest warnings against excessive protectionism. More recently, we saw another controversial use of tariffs: Trump's trade war with China, which started in 2018. Trump's administration imposed tariffs on hundreds of billions of dollars worth of Chinese imports, arguing that it would bring jobs back to America. And in some cases it did help certain industries, like US steel manufacturing. But there were also big downsides. American companies that relied on Chinese parts faced higher costs, and consumers paid more for goods like electronics, washing machines, and even beer because of aluminum tariffs. Ultimately, studies showed that the tariffs led to job losses in some sectors and cost American consumers billions. Plus, China retaliated with its own tariffs, hurting US farmers who depended on exports. With the new import tariffs in place, many investors are wondering how these changes might impact their portfolios. But before we dive into how investors can prepare for import tariffs, I want to take a moment to thank today's sponsor, FinChat. If you're looking to take your investment analysis to the next level, then click on the link in the description box below to receive a 15% discount for FinChat and unlock powerful tools to make smarter investment decisions. Now let's dive into some key factors to consider as an investor when preparing for import tariffs. Industries like agriculture, manufacturing and energy are some of the hardest hit by tariffs. However, some sectors may actually benefit from the changes, like domestic manufacturing or infrastructure. Investors may want to keep an eye on how these shifts could affect different industries. In addition to the tariffs themselves, retaliatory tariffs from other countries could play a role in shaping market movements. For example, US companies like domestic steel producers or agricultural firms might see an advantage. On the flip side, export-driven companies facing international restrictions may experience significant challenges. Trade policies can evolve quickly, with new executive orders or changes in negotiations, potentially altering the landscape. Staying informed about policy updates could be important, as these shifts could have a major impact on the broader economy and specific sectors. Companies with diversified or domestic supply chains might be in a better position to handle the impact of tariffs. On the other hand, businesses that rely heavily on global supply chains could face disruptions, which may affect their operations and stock prices. While tariffs can cause short-term market volatility, companies with strong fundamentals may be able to adapt to the changes over time. It's also worth noting that rebalancing a portfolio to stay aligned with long-term goals may be something many investors consider in times of market uncertainty. Investors might also look at ETFs or mutual funds that focus on specific sectors or international markets, which could help manage risk due to the tariff changes. Emerging market funds in particular might offer opportunities outside of the US trade conflict. Though these are just a few considerations in light of new import tariffs, it's essential to continue monitoring the situation, as the economic landscape can change quickly. Keeping an eye on these developments could help investors navigate the uncertainties that come with trade tensions. So are tariffs good or bad? The answer is, it depends. History shows that tariffs can help new industries grow, like in 19th century America or post-war Japan. But they can also backfire if they trigger trade wars, like the Great Depression or Trump's China tariffs from 2018. In general, tariffs work best if they are temporary, targeted, and part of a long-term economic strategy. But if they're too extreme or politically motivated, they can do more harm than good. For investors, the key is to stay informed and adaptable. Markets will react on new tariffs, but those who focus on fundamentals, diversify their portfolios, and understand the supply chain risks will be better positioned to navigate the uncertainty. Now, I want to hear from you. Do you think the 2025 tariffs will help American industries in the long run, or will they end up doing more damage? Drop your thoughts in the comments below. And as always, if you found this breakdown helpful, don't forget to like and subscribe for more insights on investing. See you in the next one.